Hello, good morning, good afternoon, and good evening to all of you. Thank you for joining the third of our webinars around the COVID crisis. It's been an interesting few weeks, to say the least, and I hope all of you and your families are well and safe. 2 weeks ago, we spoke about technology in the time of crisis, and we had leaders from the technology industry, CIOs, and from academia talk about how technology has grown in boosts and spurts at the end of every crisis. And there was consensus amongst the panel that this crisis is going to lead to the rise of a lot of digital and AI technology, of what was being called intelligent digital, a space where digital has a lot to play in. Last week, we cast our eyes on the mortgage industry, and we had leaders from the mortgage industry, as well as a professor from Harvard who has a deep specialization in mortgages, speak about what really are the strategies and the principles that have segregated the winners from the also-rans. We heard that, following your customers as your customer behavior changes through the crisis, staying core and close to your core value prop. And last but not least, the use of digital to stay nimble and agile are the ones that have helped mortgage lenders win in the past, and they expect the same to happen this crisis too. This afternoon, we cast our eyes on a second industry in the secured lending space, that of SME lending. And I'm joined by two leaders from the industry, and we will look at how crisis has impacted SME lending in the past and what we can expect in this crisis and going forward. My first panelist for the afternoon is Alex Lidner, who is the UK Managing Director of Boost Capital. Alex is a seasoned leader that has most recently led the growth of an award-winning fintech, which is Boost Capital. His specialization is in transformational change in business performance while developing and implementing successful growth strategies in B2B financial services. Welcome, Alex.
Hi, thank you so much for that introduction. Great to be here.
My second panelist is Manoj Karkhanis, who's the founder and CEO of The Decimal Factor. Manoj started his career as a 19-year-old selling Xerox photocopiers in Mumbai. In 2002, he sold his first business and moved to London, and was the CEO of a successful startup in the UK when the financial crisis hit. So he has some very interesting personal experiences of how he dealt with that. He has now run Decimal Factor for over 10 years. Manoj also supports a boxing charity that helps keep young boys and girls off the street. And he's also a regular cricket player. Welcome, Manoj.
Thank you, Arundham. Thank you for having me.
Right, so kicking off the conversation for this afternoon, the SME sector and the smaller the businesses, the more has been the impact, has been tremendously hit by this crisis, the same as the last one. And I'll perhaps go to Alex, you first, to talk about, what is it that you saw SME lenders do in crises of the past, and some of the learnings that you saw, and some of the personal examples you saw that really segregated the ones who won out of the crisis in the past.
Yeah, I mean, it's funny. I mean, I guess in a weird sort of way, I personally kind of benefited from the last global crisis, as ultimately it led to me running an alternative finance lender in the UK. So you see, one of the outcomes of the last global crisis was that banks restricted their lending to SMEs. And as a result, it gave rise to a bunch of innovative and disruptive financial players that then gave rise to this whole alternative finance and fintech market that we see today. So, what we've seen is that the alternative finance market has witnessed, tremendous growth through a technology-first approach, which has now kind of enabled them to provide much faster, more competitive services to small businesses. So kind of 12 years on from the last financial crisis, we now find ourselves in a world where fintech lenders are becoming much more mainstream. So, it's just interesting that, as a result of something, pretty damaging to the economy, a whole new kind of industry was born. So I guess, my kind of key takeaway from that and what I saw in the last global crisis is that, if businesses do nothing and kind of stick to business as usual, during this time, that's going to kill you. There's no chance for you. You've got to adapt in order to survive and grow. And like we saw in 2008, there's no doubt going to be winners and losers as a result of this crisis. And I think that those winners and losers will basically be defined by their ability to take positive steps forward in their digital transformation. And equally, there's going to be a whole bunch of very smart entrepreneurs that will jump in with very new innovative models specifically to handle what will ultimately become the new normal and to seize the new opportunities. So I think, it's an exciting time to see how that kind of plays out from my point of view.
Absolutely. And before I come to you, Bonus, next, something that I was speaking to a macro economist, he was saying that, in the global financial crisis in the past, the banks were in a bad shape, and, they got hit equally hard and equally quickly as the current one, but they were in a much worse shape than they were for this crisis. And, that really allowed alternative finance and startups flourish. But if I translate that to you, you saw it firsthand. So it'll be great to hear your personal story.
Yes, I mean, my association with the financial services industry has been over 15 years. And I think I want to talk about two financial services crises. One that was very local to a state in USA and had a regional impact, but still a financial crisis because of natural calamity. And I'll talk about that in a bit. And the second is obviously 2008, which has been, a global, financial crisis, if you like. So these are the two stories that I actually have a personal story that I want to share with you. It was in 2008 when, that Hurricane Katrina, it caused a lot of chaos in basically Mississippi and a small town around Alabama. And at that point, we were working very closely with the alternate finance lender. And that alternate finance lender had $2 million worth of cash advance in that little town. The whole destruction was so bad that people had to leave that town. And 6 to 7 months, nobody really came back. If they came back, it was very slow. So the alternate finance lender had no other choice but to write off the entire amount of $2 million. And they did. They said, listen, this money is not coming back. But 2 years later, something very funny happened. Okay, when they looked at their books, 2 million came back into their accounts. 98% of the SMEs paid back. Now, this was a very big lesson, right? Because, everything was destroyed. People were gone. People were starting from business from scratch. And still 98% of the people paid back. As you know, cash advance is based on something called split. So on an everyday basis, the money comes back. There's a split set up. So people who came back, each one of them, and more than 98%, would have actually not canceled that arrangement because they knew they had taken the money and they paid back. So that is when I really learned that 95% to 98% of the SMEs are SMEs with a dream in their eyes and have grit to make things happen. They are not there with the intention to take your money and run or do anything that's fraudulent. A very small percentage is, but that's very, very small. And that's when things changed for me. I was working for IT, I was chief exec, I was working as an IT-enabled services business, enabling other lenders and brokers. And that's when I decided that I'm going to dedicate my life and I'm going to start Decimal Factor. And I'm going to do what it takes to support this community of SMEs that give 80% of people their jobs. So that leads me very nicely onto the second story very quickly, which is actually exactly 1 year ago, on the 19th of May, not 1 year ago, sorry, 12 years ago, on the 19th of May, 2008, we started Decimal Factor. And when we started with a small office, as one would do, with a small staff. And hardly a couple of months into that, on the 15th of September, and I remember the date very well, the 15th of September, 2008, you saw these visuals on television where people are walking out of their office with a box in their hand. And that was the Lehman Brothers crash. And the offices were moving out. And this was one of the failure of a systematically important or, very, very important financial institution with an impact, with a seismic shock of around 700 billion. I would calculate that to around 538 billion pounds or $700 billion. And that was a huge shock. We thought that was the biggest crisis we're going to see in this lifetime. Obviously, when you see the fiscal packages now, 10 trillion, that sounds very minuscule. But at the time, and let me go back to that in a minute, for a minute, basically, and that time, this was the biggest crisis. And that was a crisis where banks weren't lending at all. And why were they not lending? What had happened? Why did the banks suddenly stop lending? Okay, of course there was a seismic shock, but what was the other reason why they were not lending? The other reason was the credit rating agencies in the US and in the UK had downed the credit scores, right? Somebody on a 500 or 800 FICO was sitting at 500. Somebody on a 500 was sitting on a 300. And in the UK, again, the credit scores had dropped. So for no fault of the individual, the banks weren't just not lending. And obviously, these are the two experiences where I've seen that, SMEs have suffered. But at the same time, I'm very proud of my industry, which is the alternate finance industry, which stood up at that time and said, no, we are going to help them. And I remember that, we as an industry stood up to that. We started funding merchants and SMEs. Until date today, I see a lot of SMEs still renewing that got on 2008. They never forget that because, banks didn't lend to them. So all in all, what I would say is that with the 15 years of, association with the financial service industry, two crises, I want to tell you that I know a lot about this, but the truth is I have no clue what is going to happen in this crisis. Absolutely no clue what is going to happen in this crisis, right? And I think I will leave it with two big impediments for the lenders that is there right now, and I'll let Alex expand on that, is that the loans that they have put out today are not coming back. If they're coming back very slowly. And especially for cash advance, because it comes on, the everyday functioning of the business, and a lot of businesses are not functional anymore.
Yeah.
Another thing that is worrying them, and the last one, is that today they don't know what's the bad debt. Is it going to be 2x of their last year? Is it going to be 3x? And is it going to be 7x? Nobody knows, right? So therefore you can't price products, you can't come out with products, and the whole thing has come to a grinding halt. Last I would say on this is that this is not about any economic theories now anymore. If anybody is giving you, I'm telling you, they're all limited. At the end of the day, what's going to happen is freakonomics, not economics, right? So Alex, if you just highlight and share a little bit more about, the impediments of the lender, that would be very useful.
Yeah, I mean, I think just to build on your point, Manoj, in terms of, how are alternative lenders dealing with this, and what are they doing right now, right? I mean, various lenders are acting in different ways, but the reality is that it's a really tough time for all alternative lenders, right? I mean, even those that have been approved for civils or the bounce back scheme, they're finding it hard, right? Their existing loan book is in deep, deep trouble with high defaults from customers that just simply can't pay back. They're having to give business payment holidays, and something that could really put less well capitalized lenders under enormous strain. So I really hope that fintech lenders and the banks and the government can all work very closely together to provide access to lower cost of capital and more liquidity to the fintech lenders to better support small businesses in the future. Because we've seen how important alternative lenders have been over the last 10 plus years in supporting SMEs. And how that industry has grown. And I think it's critical that, we all work together and partner together to make sure that we're getting the right finance out to businesses under the right conditions.
I mean, it's interesting for both of you say it, and I'll pick up on couple of points that the both of you made. From the GFC or from the previous financial crisis, the situation there was that the banks had been seriously hit, and they had stopped lending, which led to the growth of the alternative lending industry. But in this crisis, right, there is a tremendous amount of sort of government-backed funds which are being fueled both through the banks, who are arguably in a much stronger shape, as well as through fintechs. How do you see fintechs behave, or how do you see them starting to behave so that they can come out of this crisis? Because the lesson we learned last week from a mortgage industry standpoint was, all of them were saying stay close to your existing customers. Like you said, 98% of them came back. Understanding how they're going to behave, understanding how your core customer segments would behave through the next 12, 18 months is going to be fundamental. Is that something you see in this crisis too? And I'll go to you, Manoj, first.
So, are you trying to say is it going to be business as usual? Is that what you're saying?
No, I'm saying is the lesson that in order to survive, because the environment is a little bit different from the previous crisis. There's a lot of government-backed loans, right? The industry itself is much more mature and therefore had higher volumes before the crisis hit. So the survival strategy needs to be a little bit different compared to what happened in the GFC.
Yeah, I mean,
Alex, go ahead.
Yeah, no, sorry to butt in, Manoj, but I mean, listen, I think it's interesting, right? When I look at actually one of the key differences between this crisis and the 2008 crisis is that, to put it bluntly, last time in 2008, banks were very much the villain, right, of the crisis, whereas this time they actually had the great opportunity of being the hero through the distribution and the deployment of the CBILS or the bounce back loan funds. And unfortunately, and I mean, this is going to be a kind of big topic, I think, for today. Unfortunately, that just hasn't worked, right? The issue is that banks just aren't set up either with the resources or the technology currently to be able to do things quickly and to handle the amount of applications that are coming in. So, for all the banks' hard work, which they are working incredibly hard on, and the government are making some incredibly quick decisions, which is very, very refreshing. For all of that, it's just not translating into the cash in the hands of the majority of businesses who desperately need the finance. And I think, for me, one of the biggest flaws with the CBILS program, and indeed the bounce back program, is just the fact that fintechs, the kind of alternative lenders, the non-bank specialist lenders, just haven't been looped into the process early enough. They've started coming in now and joining, and that's great to see. But I think had they all joined from day one, we'd be in a very, very different position now.
I mean, is it true though that even with so clearly the inclusion of fintechs is helping in the disbursement of bounce back loans and CBILS loans, but the problem is that from an origination cycle, when you're doing the credit assessment, the credit risk, all of the SMEs, right, their business models have changed. They've come to a grinding halt. For the fintechs, despite all of the introduction of technology in terms of simplifying the origination process, that's where we play a big role. The maturity in being able to rapidly transform the credit models, there's still a wide gap between fintechs and the banks who are much more mature, arguably slower, but much more mature at being able to nuance out, how credit will evolve for these players.
Yeah. No, I mean, absolutely. Listen, I think one of the key things that lenders are going to have to do over the next few months, right, and as they kind of plow on with a new strategy post COVID-19, is to better use data, right? Data, I think, is going to be absolutely critical for all lenders going forwards. The traditional credit risk scores that we've all heavily relied on, quite frankly, for decisioning, these are now completely untested for the current circumstance that we're in right now. So I believe that the answer lies in further, richer, more varied data. For example, bank transactional data that can be combined with accounting data to provide a more holistic view of the current performance of a business is going to be critical. And I think, we need to kind of look at forming partnerships with a whole range of providers that can foster the exchange of further data. That's also going to be very, very critical. And listen, I think the reality is, what we're seeing is that if non-bank lenders or if traditional banks can't leverage data in this way, then other players are going to step in, right? We've already seen guys like Amazon, who have a huge amount of data, and they're a very cash-rich platform, stepping in and providing successful working capital loans, right? So if we can't step in and do it ourselves, then other players, the kind of more e-commerce players will, and I think that's a very key lesson.
And that's a key lead, Manoj, being a heavily online sort of broker of these loans. You're probably seeing a tremendous flow of applications from the SME sector into various kinds of loans. What are the kind of operational challenges you're seeing, and how are you dealing with them when it comes to the lending process?
So there were two types. One was one was the day before 23rd of March, when actually the Right Honorable Rishi Sunak, went on to the dais and said that, he announced the 330 billion fiscal package. Before that, people didn't know what to do. They were, going out there and saying, listen, can we get some loan? What can we get? The lenders were completely freezed. They were in a frenzy. They didn't know what to do. The monies were not coming back. And that was the situation. So what actually happened on 23rd, when, the Chancellor of the Exchequer, Rishi, announced this scheme, the applications just started coming in left, right, and center. People wanted to know how they could get CBILs. There was nobody on the line. So luckily we had a large, center which was functional. We have it in a central geolocation in Bahrain, and we were all active and were able to take calls. So we were probably one of the very few who were actually talking to the customers. And what they wanted to do was get over the CBILs loan. And I still remember the words, and it said, Rishi said, whatever it takes. And in a way, I think, like Alex says, that CBILs didn't really work. But I would say that, the next scheme, which was the bounce back loan schemes, did work. I mean, it was something that Rishi did not want to do. He did not want to guarantee a 100% guarantee scheme. He came on television saying, I'm not dishing out the monies that, have been taxpayers' money just without guarantees. I'm not for 100% loans, but he did it. And I think that was good, because of the 22 billion loans dispersed as of 17th May, 14 billion were bounce back loans, right? So if you look at the numbers, 581,000 people in the UK, applied for these bounce back loans, 464,000 got it, 80% approval, 33,000 loans per day. That has been an amazing achievement, Alex, and you have to give it to the government. I mean, that's
100%. Listen, 100%. I mean, you're absolutely right. And listen, again, like the government, the banks, the British business banks, they have done a phenomenal job. I mean, they are working desperately hard and coming up with amazing, quick decisions to free up capital. But again, listen, I totally agree with you, Manoj. But the fact is, the bounce back loan also has its issues, right? I think that, firstly, I've spoken to many small businesses. Providing 25% of their 2019 turnover with a max of £50,000 is very nice. It's a very welcome amount of money for every business, right? But it's a drop in the ocean compared against what they need, given the fact that they've been out of business for so long. And also, you're now seeing, and it's kind of been quite widely reported, that over the last few weeks, the accredited bounce back lenders are also massively struggling with just the volume of applications that are coming through. And because there's lending limits that have been placed on the accredited lenders, it's taking a while for the British Business Bank to approve higher limits. And that's also causing some big delays. And again, listen, my eye is always firmly in the corner of alternative finance providers. And quite frankly, the bounce back scheme has not done us any favors, because it's very, very difficult for a non-bank lender to participate in the scheme because the interest rate has been set post the first year at 2.5%, which makes it completely not viable for non-bank lenders to afford to participate in the scheme. And, so I think that's a big issue. And I also think that, quite rightly, the accredited lenders that are participating have had to restrict their bounce back loans to supporting just existing customers. So it basically means that the market is effectively closed off for those businesses that have chosen to bank with a challenger bank or a non-bank lender. So listen, agree that great that we're seeing a bit of money out in the economy, but there's also flaws with that. And I think we can't stop there. We've got to keep the government on their toes, working and thinking of new schemes and new ways in which to release capital.
Alex, I can share with you that, a lot of SMEs getting the bounce back loans was magical for them. Especially, and I work very closely with alternative lenders like yourselves. You make us pull teeth to give them even 15,000, and 50,000 written to them was like miraculous. Okay. So please, that was the good thing. And listen, it's not about how much. It's like, can they get over the line this month? Can they pay their bills?
Right.
It's very important. It's not about how much, it's when. So today, if you've given them quick money in the hand through bounce back loans and 14 billion, you're talking about the whole UK market being 77 billion, almost 1/3 of that you have done in 2 months. Amazing. I think give it off. But then again, when it comes to CBILS, I'm with you. That's done so badly. And the larger schemes, which out of only 496 firms, only 86 have got 50 million worth of funding. So even that's very less. We've got to do more. And I hear today that there's been schemes that have been announced for 200 million, that range. And we'll see what happens with that. So I'll just end on this note. Whatever it takes are great words. But without banks, fintechs, lenders like you, brokers like us, all of us together, these words would have not meant anything, So I think to the ecosystem, let's give it. It was a difficult crisis. Money's out, and I think it's more to come. It's not one and all, right?
Yeah, no, exactly. That's the hope, right? I think the hope is that there's more to come, and I think the hope is that the government kind of can keep on being reactive, right, and keep on reading what's going on in the market. Listening to the small businesses, the banks, the alternative lenders, and the community of everyone that's trying desperately hard to get money out there, and responds appropriately with either adjustments on the current schemes or new schemes to try and enable the distribution of money. But listen, obviously it's not just on the government. Alternative lenders themselves have to step up and do all they can to release whatever capital they've got and find new ways of assessing businesses.
Yeah.
Absolutely, and it's probably worthwhile now casting our eye to the future. So clearly, I think one of the reasons why CBILS didn't work as well as Bounce Back did was because the underlying credit assessment model was completely different. The banks were still having to do assessments that were not completely backed by the government. But like you said, even in the Bounce Back loans, when the volumes really went up, even the big banks, including the fintech, started to struggle in terms of the turnaround.
Yeah.
Now, obviously, these government loans, across countries now has had a big impact on the balance sheets of the governments. Where do you see the industry growing? What is the role now, do you think, that alternate finance players can play and the SME lending industry can play going forward in terms of helping out and therefore surviving or even expanding? What are some of the tea leaves to be read, if you were to say, that will help the industry?
So Alex,
Let me go.
Yeah, I think listen, one of the issues again with just the banks not being able to cope is just because their technology isn't there, right? So I think as a result of this happening, it's hopefully forced banks, and it will also force a lot of alternative lenders, even the more digital ones, to kind of consider carefully their digital roadmap going forwards and do more and kind of really push them to come up with a fully digital system. For example, they really need to think about accelerating their sales and services functions. So anything that previously required in-person interaction basically needs to be rethought about, and a new plan needs to be put on making these things digital. So, for example, can e-signature or digital ID processes be quickly deployed? What transactions can be moved to more conversational platforms like Alexa or WhatsApp? How can us lenders rapidly bring on board new customers, whilst at the same time making sure that we're doing the appropriate cyber fraud KYC checks? So, basically we all need to move to 100% digital as quickly as possible, minimize in-person interactions, ramp up anti-fraud and cyber protections. So there's a lot, I think, that this situation is making us do to rethink our digital strategy. I also think, just to continue that kind of line of thought, there's a bunch of kind of newer technologies that are coming into play here. So I've been reading a lot about kind of what the US has done and how they've responded to this. And one of the things that they've done is they've really embraced what's called robotic process automation. And it's a result of this technology that's really enabled the lending institutions in the States to automate thousands of loan applications for small businesses under the payroll protection program. And it's those kind of technologies that the banks, the alternative lenders should really be looking at now to really cope in this new environment.
Absolutely, and I can speak to it because we actually have our products out there which use AI technology, which is one step ahead of robotic process automation. And we've actually got a product out in the market which completely automates the origination process all the way till it comes to the credit underwriting. So you can read the application, you can extract the data out of the documents, you can spread it, you can set this up till the underwriter needs to do the credit risk. There's a lot of work in the industry going on around creating these automated underwriting models, which will further reduce the ability, the dependence on experienced underwriting. And the plug-in from external data providers, Alex, like you said, that there's so many sort of startups now who are providing pieces of data which can help in the origination process. Our product helps plug in all of those pieces, and we're definitely seeing the impact. I think right. From a broker standpoint, Manoj, because you don't do the entire underwriting and you pass it on to the lender, I think the dream of a one-click brokerage, so one-click user or the SME applies the loan, and with zero touch you're able to pass it on to the lenders. Is that dream becoming a reality now?
See, Arindam, I want to track back a little bit. Okay, coming to technology, I would like to come to technology in a minute. But I think we have to look at the current scenario, okay? We cannot behave like it's business as usual and there's nothing happen and kid ourselves. It's not true, right? The reality is that right now, everything is happening government-backed. Okay, now let's go to the basic of the scheme, okay? The CIBIL schemes is nothing but an upgrade of the EFG scheme, Enterprise Finance Guarantee Scheme. Okay, that was meant to be given when people didn't have enough collateral in their PG. Okay, you took that scheme, and because of the hurry and the crisis, you made that call, you called that CIBILs. And what did you do with that scheme? You took away PG from it, right? Now, the moment you took PG out of it, right, you had almost 3 to 5 lenders leave the scheme, because a lot of the finance companies that operate cannot even lend without a PG. So you killed that scheme. So there is a intrinsic issue with that scheme. Then you made that scheme up to 250, 80%, and you made no fees, what have you, right? So you have a scheme right now. So right now you have a CIBIL scheme which will lend a viable business. It will lend a business not for growth, not for getting dividends to the shareholders, but to survive. So the whole underwriting has changed. What we know as underwriting is no longer the underwriting. If I said I'm going to become, grow at 300% next year, I will not get the loan. If I'm not surviving, I'm going to get the loan. So the whole underwriting parameters have changed. So there is a in-depth change in understanding of what we are lending and for what we are lending, right? And I think in this given crisis, when you look at it, okay, you see that there are actually in this situation, which is the COVID-19 and the lockdown situation, there are two problems for two financial problems. One is a liquidity problem, and the other is an insolvency problem. The liquidity problem, okay, you can tackle with a debt instrument, but for the insolvency problem, you need equity. So basically, these are all basic fundamental questions of lending that are now coming up. So first, before we go in 2025, okay, let us first go back a little bit. Let us go to the fundamentals of, finance. Let's make that strong. So we need to now first understand which business can afford a loan, which business cannot afford a loan. And then it comes to technology. And another question I would like to ask everybody in this panel, basically, do you think the credit scores are even worth a penny at this moment? I mean, the credit scores have completely gone out of the door, right?
Yeah.
So in this, I'm so sorry. Let's finish on this flow of thought. So where you have got the basis change, you're going back to the fundamentals of the business. You're getting to understand whether it's a debt or equity. Once you understand that whether it is affordable, they can afford it or not, it is credit worthy, yes or no, then technology comes into play. And where I think technology will play a great role is not in the sci-fi side, okay? The robotic side or the great AI side. Great, it'll come at the right time. But right now, what you really need is auto decisioning. You have a matrix of different lenders, schemes, what have you, right? You want quick decisions, you want to guide. And there are two things you want to do. You want to reduce the risk of rejection. So you want to get more approvals to the SMEs, to the right scheme. And two, because of the volume of applications the banks and the finance institutions and the financial services is having, reduce the cost of non-conforming applications. So these are two things I think can be very nicely tackled by technology. Technology needs to be focused rather than trying to say, oh, close your eyes, to the real world. You should get.
I think you're absolutely right, Manoj. I think these points go hand in hand, right? I mean, the reality is that because the credit score that lots of lenders used to rely on is kind of to a large extent gone out the window. As I made the point before, other data is going to have to step in to kind of help us to assess the affordability of small businesses, right, in this climate. So having different and varied sources of data is one thing that we're all going to have to do. But then what you've got to do is to be able to analyze and read that data in different ways, right? So you're going to have to leverage technology in order to do that. Lenders will need to dynamically be able to adjust their underwriting models and have tools to be able to handle multiple underwriting models for different types of scenarios. And we're all going to have to have the ability to read cash flow patterns and track data and leverage, great AI in order to make these auto decisions, as you say. These are presenting us with real challenges, but challenges that 10 years ago would have been impossible now are very realistic with the technology that's out there.
No, and I agree. I completely agree with you, Alex, there. And I would go on to say and build on what you said and said the conventional underwriting knowledge is going to be rewritten now, okay? And at this point, you ask this question to yourself, whether you want it to be pattern-based or you want to be criteria-based. And I think if it's going to be pattern-based, AI is right now is the time to bring AI and put it in the front of everything. But let me ask you this question, Alex, and I would like to know your views on that. What do you think the regulators will react to when you go on pattern-based lending? What do you think the investors will react to when you go on pattern-based lending? Tell them that you're doing on, lending on some AI logic. Will they approve of your, lending? You tell me that. In reality, is that possible?
I mean, again, for this whole industry to survive, I think everyone has to adapt, right, including the regulators. So, we've all got to look at things with fresh new eyes, with a sensible head, and I think that we have to all embrace the great technology that that is out there in the market right now to help us to do things in the right way for the best interest of small businesses. So I think, quite frankly, I don't know. Clearly, I don't have a crystal ball in front of me, but I certainly hope that everyone looks at things with fresh eyes and with a level head.
Yeah, and living and breathing this every day. So 2 points. One is, I don't think AI is sci-fi. I think AI is real, but the mistake that a lot of players out there are making is they think that AI is going to replace the human touch. It will never do that. I think you will, so we call it bionic processes and augmented processes. Your AI, so the technology that you're talking about from an auto decisioning standpoint, we call it from an augmenting standpoint. So how do you help the packager or the underwriter be much more productive, bring down the cost of operations and improve the throughput? I think that's where we are seeing, and our existing products which are deployed are actually helping doing that on an everyday basis. The other thing is, from a pattern-based standpoint, the stream of technology, so machine learning, which is mostly pattern-based, looks at patterns of the past, right? Whereas you have, the patterns have completely changed. The way your businesses and your applicants are behaving, the way their cash flows will behave, have got nothing to do with patterns with the way cash flows have behaved in the past. So the ability to apply AI using pattern-based, in my opinion, is quite low. I think you have to use other dimensions of AI, which is a combination of rule-based, expert-based, which is going to help you sort of improve the efficiency. And given the fact that the cost of operations is going to be a big challenge going forward, everybody's trying to cut down costs. I think there are certain streams of AI tech which will help you do it.
Yeah, I think listen, I think you're right, and I also think that listen, lenders should always have an outlook on who the next generation of small business owners are going to be, right? And even before the COVID crisis, we were seeing the rise of the millennial generation, those kind of digital first kind of entrepreneurs that were really setting kind of new demands on the industry. They wanted to be able to operate from their mobile phone. They wanted greater transparency. They wanted flexibility. They wanted the experience to be entirely streamlined. They didn't want to have to talk to anyone, and they wanted loans immediately, right? So that's the demands of this millennial generation that we're dealing with, and I think that's only going to be heightened as we kind of come out of COVID. So I think it will be in the lender's best interest to have a kind of a millennial first or digital first or a mobile first strategy to appeal to these new audiences, and try and leverage, as I kind of said before, all the new technology, the data science, and the experiences that these new audiences will be expecting. And I think it's only those lenders that do that will really be able to kind of dominate in the new environment.
So Arindam, Alex, I do take it on the chin. I mean, the future is technology. We all heavily investing in that. So is decimal factor, and we are going down that route, okay? And we all want to be really sci-fi as far as loan is concerned. We want it to happen without even any friction, okay? And we all are working towards that. But let me make a small puncture in your sci-fi bubble, gentlemen, okay? The next 12 months is all going to be about 70 lenders on CBILS lending, okay? I want to see one lender who can get up in this market and lend. I have not seen any. So all this logic of great technology and, your pattern matches and scores and what have you, please, for the next 12 months, throw it out of the door. Let's focus on getting the applications in, money is out, surviving businesses, ensuring that, the loans from the lenders are reached to the, SMEs. British business banks are adding digital banks and fintechs every day. So fintechs, as I agree with Alex completely, can make things faster, efficient. The way digital banks, like he said earlier, is handling volumes. Starling Bank this morning went back to the government and said, we finished the money. Finished. Where is my next allocation? It's finished. And, you've given banks such a large of allocation and they're still struggling with 7 million loans dispersed so far. 7 billion, sorry. So, the truth is technology right now is needed for fast disbursement, quick analysis, to the reality. Government loans. See, government is very, very serious. You are not going to take my money and put it into, into the hands of as dividends to the shareholder. You're not going to use my money for growth. This is taxpayers' money. You have to use it for the survival and of the economy. It is very clear. It's a different kind of money. And next 12 months, I dare, a lender to come and lend. And I want to see that, because I am the first one to partner with them to see that we'll reach their money to the SMEs. There are no lenders. They're all government distributors.
I think we just need more lenders being part of these schemes, right? That's the reality. Different types of lenders, specialist lenders, non-bank lenders, the fintech lenders, right? They have to come into the scheme and they have to come in quickly. What it seems to me at the moment is that every kind of weekend, the British Business Bank is announcing kind of 2 or 3 or 4 new lenders. That's not quick enough, right? If you compare that to what happened in the US, where 5,000 plus lenders were involved in distributing the paycheck program, and they distributed the entire $310 billion in under 2 weeks. That's what it takes, right? We've got 60 plus lenders in CBILS right now, and less in the bounce back scheme. It's not quick enough. So again, for all the best efforts in the world, it's just not happening fast enough.
So just great conversation, both Alex and just conscious of time, and there's a number of questions which have come from attendees. So I'm going to go to one first. So the first one is from a gentleman called Anuj Khanna. So in the short-term loans under 50,000, I'm assuming he's referring to the bounce back loans. The entire SME demand has been captured by lenders who can disperse bounce back loans. What are alternative finance providers expected to do to counter this, right? Either till November 2020, which is when the bounce back loans scheme runs out, or beyond. What can be some of the ideas which alternative finance providers can lean on? Let me go to Alex first.
Yeah, I mean, listen, I think, I kind of stand by my view that I said earlier on, right? That I think that whilst the bounce back loan is something, and 25% of the 29 turnover is not to be sniffed at, it's, again, in my view, it's a drop in the ocean, right? Compared against what businesses really need to survive and prosper, right? They've been out of business for so long, and they're going to be out of business. Retail or pubs are going to be out of business for another month or two. And they need more capital despite the bounce back loan scheme. So alternative lenders have a huge place to provide that capital to small businesses, because I think that banks are going to continue to struggle to provide that kind of finance, because they just have totally different underwriting criteria for very good reason. Their models are set up in very, very different ways. They typically require assets that most small businesses don't have assets to put up and offer. So it's going to have to be a lot of unsecured lending that needs to go out. And, for all the things that we discussed previously, alternative lenders are going to have to, adapt their underwriting models, get more data, the technology, blah, 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 to be able to cater for this massive demand in capital that's likely to rise over the next few months.
So are you therefore saying, offer products which are similar to bounce back loan, which is unsecured, so not attached to a PG, with no cap on the upside, equally quick as a bounce back loan, but priced differently?
There's got to be various forms of lending. There's some amazing kind of asset finance, invoice finance players out in the market right now. There's the merchant cash advance lenders that I think is a fantastic product for those businesses that have high card takings, where the repayment is basically set as a percentage of the business cash flow. So ultimately, it's a very flexible product. There's lots of different forms of alternative finance, and not many business owners know about these different forms of finance. They don't know about these special lenders out there. So again, I think it's up to those lenders, the government, the media, to make a big shout about what options are out there for small businesses during these times.
And I keep going back
to add to Alex, to summarize, in my opinion, the immediate and urgent lenders will have to adapt to are one, they will have to keep adapting to selling or distributing the government-backed schemes. That is one. But again, like Alex said correctly, yes, there are many forms of lending. The lenders have to be brave, have to enter the market. They can't be sitting on the fence anymore. They have to come in there and they have to sell their products. Again, whatever the products is, whether it's a cash advance, it's a cash flow product, it's a VAT-based lending, if it's a property-based lending, it's a property development finance, you have to do it. You have to be brave. You have to cherry pick, but do it. And what you need to do is reduce the yield. You cannot have those crazy yields anywhere. Everybody's got to take a hit, lower the yield. And last but not the least, they have to manage their bad debt to the balance sheet very, very closely. So they have to, wherever the risk is high, they have to go on government-backed schemes. Wherever the risk is low and there is a growth story. So the simple story is survival, go to government. Growth story, go back, make the growth happen, right? That's the job of the alternate lender. And in a very brief summary, what I would say is that the new normal, okay, which is going to be for the alternate finance industry, where banks, digital banks, fintechs alike will be backed by the same government bank guarantee. So no reason why we'll not be equal playing field and everybody can, compete equally. And therefore, I would say the alternate finance industry has now to get up and drop that word alternate and become mainstream finance. This is the time.
Absolutely. And I completely support that. And I would say that, in addition to being quicker and nimbler than the standard banks, I think one of the greatest advantages that the fintechs have is the ability to use digital to understand where their customers are going. A lot of the new products which will get launched is going to be on the basis of understanding what are the needs of these customers beyond the bounce back loans and beyond the survival loans. So in the new world, what kind of financing is really required for growth? And if they can leverage their skills, their digital, their technology skills, to be able to understand their core customers and how they're behaving in the new world better, I think they're going to be much more competitive than the standard banks.
Yeah, I mean, I think it's a great point, and I think what's interesting to see, and I really enjoyed kind of reading the stories of other lenders or other players in the market in terms of what they're doing, even in just like the short term, in terms of some of the innovations they're coming up with. So, I really praise Market Finance, who are typically focused on just invoice financing, and now they've kind of expanded into new areas of business lending. So they set up a tool for companies to be able to borrow money against their HMRC payments for the furlough scheme. So, really, really great initiative. I don't know how successful it's been. I haven't read about that, but, in theory, a really fantastic initiative. And, a very quick decision made by those guys to kind of do that. So real praise to those guys. Cabbage in the States are offering gift certificates to small businesses to sell to their customers. So again, a cool product in this environment. I was reading about Amazon and Facebook. They've both launched grant programs specifically aimed at small businesses. So there's lots of innovations that are happening already, and I think it's really refreshing and great to see, and I hope to see a lot more of that.
Great. I think we have time for just one more question. Unfortunately, I'm going to go to a question raised by Milind Kangle, and maybe Manoj to you. What strategic differences do you see in the US market as compared to the UK one, our home market, in the sector?
So the key difference here basically is that the maximum money that has been put in the US market, as Alex said earlier, is a PPP scheme. The LIDL scheme is not even functional at this moment. And I can see Craig is online. Craig is our president in the United States, and he has, kind of filled me in on a few of the things. But you can see a lot of, loans that are, backed by property. So cash advance, backed with a cash advance against property is kind of a new product that we've never seen before. So people are pivoting, yeah, and there is a new breed of new products coming out, and hopefully these products should be able to address the market. But then again, you've got to go back to the conventional one, and the comparison between UK and US is simple. US SMEs will not take loan unless they see they can grow and use it. USA, you gave them loan, they will take it without a blink of an eyelid, and they will figure out what they will do. The tenacity of both entrepreneurs is great, but the attitudes and the approach is slightly different. And therefore, that reflects on how the lender is going to look at and reach out to them. You will see a more take in the US. You will see a lesser take of higher interest rate loans in the UK. But all in all, there is a lot of money needed in all markets today. The capital markets are busy. Everybody's busy. Money is badly required. That's the only second ingredient after oxygen required for coronavirus based, interruption.
Wonderful. Alex, any closing thoughts on that?
No, listen, I agree that that's, capital is what's needed by everyone right now. And I think we've discussed some great points here in terms of, all the different things and ways in which lenders can adapt. And, my kind of, I guess, closing message is just the hope that the government, the British Business Bank, fintechs, they all partner together and just listen to each other and work very, very closely together to kind of build the kind of new generation of what we need for getting money out there quickly and easily and efficiently to support these businesses that are just desperately struggling right now.
Wonderful. So if I may, just close on all the comments. Is it therefore fair to say that the three key things for focus on for the alternative finance sector, drop the word alternative, become mainstream? I think from an industry standpoint, collaborate across government, other partners, disbursement, and last but not least, everything is, everything other than debt, taxes, and technology is certain. So stay focused on tech.
Yep, I think that's a great summary.
You had to land your plane there, wouldn't you?
Yeah. That was plug in there. Gentlemen, it's been excellent to have you on the panel. We're going to just do a very quick survey. So Ishani, if you could launch a quick survey. So we have 3 questions which we're asking all panelists and the attendees. If you just take a quick 2 seconds to read through them, send in your responses, I think it'll be very, very valuable. Fantastic. Thank you for that. Big thanks to the panelists, big thanks to the attendees. We are thinking of conducting, so as I've said, that in my view, the crisis is going to go through 3 phases. We have the health crisis, which we're now slowly but surely coming out of. There is the impending economic crisis, and then there's the broader social crisis, which we'll see in the 2 to 5 year range. We are thinking about constructing a panel of economists from around the world to talk about the social crisis and what it's going to have on macroeconomic trends. Some really, really interesting insights on what's happening to sovereign flows and how countries are behaving because of the big impact that governments have taken and central banks have taken on their balance sheets. We will probably have that in a couple of weeks, but we will announce that shortly. Thank you so much. Thank you to all of the panelists, and hope you have a wonderful rest of the afternoon.
Thank you, guys. Stay safe.